Hello viewers and my students, welcome to my channel. I am Hashim Ali Khan here. So presently I am discussing about the subject cost accounting. In this subject we are doing the topic called material. So previous video I have given the complete explanation regarding the introduction theory explanation of material costing. How material is important in the cost of production and how to control the material. What are the techniques available for controlling, managing the material. All these things I have explained in detail regarding the EOQ technique, regarding the levels, inventory levels, material levels, and regarding the pricing issues. All these things I have explained in detail in the previous video. So if you have not watched the first video, please go to the playlist of my channel, select the subject cost accounting. In that cost accounting subject, select the topic material. Watch the complete video of introduction part of material, then you start the problem. It will be easily understandable. Otherwise, if you join in the middle, you may not be able to get the complete grasp. So if you are new to my channel, first time if you are reviewing my channel, so I suggest my viewers to please visit the playlist. I have uploaded many videos on different subjects like financial accounting, advanced accounting, corporate accounting, business statistics, financial management, investment management, so many subjects videos I have uploaded. Select your concerned subject, watch the complete video, definitely you will get more command on the subject. Now, before starting this video, I have a request. Please take a copy, print out of the problems which I have provided in the link under my description. So go to the description, last line you will find the link, take a copy of the problems and keep it ready before watching the video. Now I am going to start the next problem. Already 5 problems. In the previous video I have completed 5 problems on material. Now I am going to start the 6th problem. Come on, see the 6th problem. Find out the economic ordering quantity of raw material and packing material with the help of following data. See here, we are required to calculate the economic ordering quantity. Again I repeat, EOQ is that quantity at which the quantity which is to be ordered to the supplier at which the total inventory cost will be minimum. That means how much quantity to be ordered at a time to the supplier so that the inventory cost will be minimum. The inventory cost consists of carrying cost and ordering cost. More orders, more ordering cost, but carrying cost will be less because we are holding small quantity of material at a time. So when ordering cost is more, carrying cost will be less. Suppose if orders are less placed, if few orders are placed, then definitely ordering cost will be lower, but carrying cost will increase. So there is inverse relationship between ordering cost and carrying cost. Our objective is to minimize both the cost. So how to minimize both the cost? By using EOQ technique, economic ordering quantity. It is that quantity to be ordered at a time so that the ordering cost and carrying cost will be minimum. So how to find out EOQ? There's a formula 2CO by I under root. So here in this problem we have to calculate the EOQ for raw material and packing material. 2 materials are given. So we are given the data cost of ordering. Cost of ordering means ordering cost. For raw material ordering cost 1000, for packing material ordering cost 5000. Then cost of holding inventory. Cost of holding inventory is nothing but the carrying cost. We can call it as carrying cost or we can call it as cost of holding inventory, means same. So what is the cost of holding inventory or carrying cost? Raw material 1 paisa per unit per month. Here the time period is given in 1 month, so we take period as 1 month. So raw material, the cost of holding the inventory or carrying cost is to carry 1 unit of material for 1 month. The cost is 1 paisa. 1 paisa means rupee 0.01. 100 paisa is equal to 1 rupee. 100 paisa is equal to 1 rupee. So 1 paisa means 1 divided by 100, you will get 0.01. Rupee 0.01 per month. Similarly, for packing material it is 5 paisa per month, per unit per month. 5 paisa per unit per month. So 5 divided by 100, you will get 0.05. Rupee 0.05. This is the carrying cost for packing material, and production rate 2 lakh units per month. This production rate, that means usage, Usage of the material is 2 lakh units per month. Here the data is not given for year. The production rate is given per month and the cost of holding inventory is also given per month. So we take per month only. Now see here. Calculation of EOQ, I have given the formula. EOQ is equal to 2CO by I under root. C is equal to annual usage, or in this problem we'll use monthly usage. So you can take the period as 1 year or you can take the period as 1 month. In our problem it is given 1 month. So we'll take monthly usage. Then ordering cost per order, that is given in the problem. Carrying cost per unit per annum. When you are taking here annual usage, here also you should take per annum. If you take here monthly usage, here also you should take per month. So both the cases you have to take in months or both the cases you have to take in annual. Now raw material. Raw material के लिए EOQ is equal to 2 into annual usage. How much is the annual usage? 2 lakh units given in the problem. Ordering cost for raw material is given 1000 rupees. So 1000 rupees I have taken. Denominator I stands for carrying cost per unit per annum. Cost of holding the inventory. It is given 1 paisa. 1 paisa का मतलब 0.01 rupee. Because 100 paisa is equal to 1 rupee. So 1 divided by 100 you will get 0.01. 0.01. So if you multiply the numerator divide by 0.01 under root, you are going to get 2 lakh units. So 2 lakh units is the EOQ for raw material. Now I am coming to the packing material. Packing material same formula, 2 into annual requirement 2 lakh units same. But the ordering cost is 5000 rupees. Here the ordering cost was 1000, here it is 5000. And the cost of holding the inventory carrying cost is 5 paisa per unit per month. So 5 paisa का मतलब 5 divided by 100, 0.05. So multiply the numerator, divide by 0.05 under 2 lakh units. So both raw material and packing material we are getting EOQ as 2 lakh units. That's it. This is the end of problem number 6. Now I am reading out the problem number 7. Now see carefully. After inviting tenders, 2 quotations are received as follows. A company has issued the tenders for the requirement of material. Then suppliers have given 2 quotations, A supplier and B supplier. A supplier has given the quotation rupee 1.20 per unit. That means A supplier says we agree to supply the material at 1 rupee 20 paisa per unit. And B supplier says 1 rupee 10 paisa per unit plus 3000 rupees fixed charges irrespective of units ordered. That means A supplier says we supply the material at 1 rupee 20 paisa per unit, no fixed cost at all. Whatever number of units you want, we will supply it at 1 rupee 20 paisa. But B supplier say we supply at 1 rupee 10 paisa per unit plus 3000 rupees fixed charges irrespective of number of orders, number of units ordered. So there are no fixed cost in case of A supplier, but the variable cost is 1 rupee 20 paisa. Every unit 1 rupee 20 paisa. B supplier, there is fixed cost of 3000, but the variable cost is 1 rupee 10 paisa. Now ultimately it is asking you advise with your argument with whom orders to be placed and what quantity is to be ordered. Ultimately the question is the company should give the order whether to A supplier or to B supplier. A supplier 1 rupee 20 paisa per unit, no fixed charges at all, whatever number of units you order. B supplier says 1 rupee 10 paisa per unit plus 3000 rupees fixed charges irrespective of number of units ordered. That is a clear cut case. Now we have to select any one of the supplier A or B. Now see carefully. It's a very logical problem. Try to understand quotations. A supplier's quotation is 1 rupee 20 paisa per unit. B supplier quotation 1 rupee 10 paisa per unit plus 3000. Now to whom order should be placed and for what quantity, that is the question. Now how to solve? In this case we calculate break-even quantity. So what is this break-even quantity? That quantity at which the total cost will be same whether we purchase the material from A supplier or from B supplier. At what quantity the total cost will be same from both the suppliers, A supplier and B supplier. That is called break-even quantity. Now, That is that quantity at which the total cost will be same from both the supplier. That is break-even quantity we calculate. Let the number of units at which the total cost will be same from both the supplier be X. Now we suppose X is the number of units at which the total cost from supplier A is equal to the total cost from supplier B. X is the number of units. We have to find out X. Now total cost from supplier A, rupee 1.20 into X. Each unit 1 rupee 20 paisa. 1 unit 1 rupee 20 paisa. How many units we are purchasing? X units. So 1.20 X. This is the total cost from supplier A. Now the total cost from supplier B, 1 rupee 10 paisa per unit, 1.10 X plus rupees 3000. 3000 rupees the fixed charges applied by B supplier. So 1.10x plus 3000 is the total cost from B supplier, and 1.20x is the total cost from supplier A. Now break-even quantity. The break-even quantity is the total cost from A supplier is equal to the total cost from the B supplier. That is called break-even quantity. So A supplier total cost 1.20x is equal to B supplier total cost 1.10x plus 5000. Now bring the X variable at one side and constant at other side. Already 1.20 is there on LHS. Bring this 1.10x to LHS. So plus will become minus. So 1.20 minus 1.10x. This is on RHS. I brought it to the LHS. Is equal to 3000. So 1.20 minus 1.10, you will get 0.10 x is equal to 3000. X is equal to 3000 divided by 0.10. So X value we got 30,000 units. So what does it mean? If the ordering quantity is 30,000 units, the total cost from A supplier is exactly equal to the total cost from the B supplier at 30,000 units. Exactly 30,000 units. Therefore, the total cost from both the supplier will be same when the number of units ordered is 30,000 units. Exactly 30,000. Now, what will happen if we order less than 30,000? What will happen if we order more than 30,000? Now, I have given the explanation, conclusion. If the quantity required is less than 30,000 units, then supplier A is better. That is 1.20 per unit. Now, we suggest the company, if the requirement of material is less than 30,000, that supplier is better who does not have the fixed cost. So which supplier does not have the fixed cost? A supplier, 1 rupee 20 paisa. So if the requirement is less than 30,000, we suggest to purchase from supplier A at 1.20 per unit. If the quantity required is more than 30,000 units, then supplier B is better because its variable cost per unit is less. Variable cost per unit is less. How much is the variable cost per unit from supplier B? 1 rupee 10 paisa per unit plus 3,000. So ultimate conclusion, if the requirement is less than 30,000, we suggest to purchase from supplier A. If the requirement is more than 30,000 units, we suggest to purchase from supplier B. If the quantity required is exactly 30,000, indifferent, purchase it either from A supplier or from B supplier, it does not make any difference. Both the suppliers' total cost will be same when exactly 30,000 units are required. That's all. This is the complete explanation of this problem number 7. Now I am coming to the problem number 8. Given cost of material 500 kilogram at 10 rupees per kilogram. A company has purchased the material. How much? 500 kilograms at rupees 10 per kilogram. So 500 into 10, 5,000 rupees cost of metal purchased. Insurance 86 rupees, freight 175 rupees. Any incidental expenditure incurred in purchasing the material will be added to material cost. So 5,000 rupees material we have purchased. Apart from that, insurance charges and freight we have paid. So both insurance and freight will be added to the cost of material. Due to mishandling in transit, 10 units are lost. So normally there will be loss in quantity in loading and unloading or in transit. So while in transit 10 kilogram material is lost. So actually we have purchased 500 kilogram. By the time it is usable, it has become 490 kilogram because 10 kilogram material is lost in the transit. So we are having a net quantity of only 490 kilogram. Now, at what rate can this material be issued to production? Ultimate question. At what rate this material will be issued to production? It's very easy, simple problem. Rate of material to be issued to production. This is the table I have prepared. Purchase price of material, 500 kilogram material we have purchased at rupees 10 each, 5,000. To this we have added insurance 86 and freight 175. The total material cost comes to 5,261. This is the total material cost. Quantity of material purchased in kilogram, 500 kilogram material was purchased. And how much quantity of material lost in transit? 10 kilogram of material were lost in transit. So deduct 10 kilogram. So 490. This is the net quantity of material available for production. 490 kilogram is the net quantity of material available for production. Now ultimately it is asking you what is the price of material to be issued to production. What is the price of material per kilogram? Price of material per kilogram to be issued to production. So what is the total cost? 5,261 is the total cost. How many kilogram is net amount, net quantity available? 490 kilogram is available. So divide 5,261 divided by 490, you will get 10 rupees 74 paisa. Rupee 10.74 is the material cost per kilogram to be issued to production. That's all. So this is the end of problem number 8. Now I am starting the next problem, that is problem number 9. See carefully the problem number 9. The annual accounts of a trading company are to be made up to 31st December, but it was not possible to carry out stock taking until January 5th, at which date stock was valued at a cost of rupees 68,567. So in a company, the annual accounts every year are prepared on 31st December, but the stock taking was delayed. The stock taking was not done on 31st December, but the stock taking was taken on 5th January. So instead of finding out the value of closing stock on 31st December, we have calculated the value of closing stock on 5th of January. So from this problem, we have to find out what is the value of the stock on 31st December. In the problem, the value of stock is given on 5th January. 5th January. So we have to come back. We have to come back from the value of stock on 5th January to the value of stock on 31st December. So we have to find out what are the transactions that took place from 1st January to 5th January. Right? Now, on 5th January, the stock was given as 68,567. Now, the following transaction took place between 1st Jan and 5th January. Goods received means purchases. The purchases are made from 1st Jan to 5th Jan, 4,600. So these purchases were made after 31st. It was not on 31st, right? So what we'll do, we'll deduct it. We are given the stock value on 5th January. So from that value, we deduct the material which is purchased from 1st January to 5th January. So how much material was purchased? 4,600 worth of material were purchased. So what we have to do? We have to deduct. Now, goods returned. These are purchase return. Goods received are purchases. Goods returned are purchase returns. The purchases we have deducted. The purchase returns we will add back. So this 4,600 rupees will deduct because these are the purchases made after 31st. And purchase returns after 31st is 200 rupees. So this we add. Now sales 10,500. Sales means goods are sold away from 1st January to 5th January. That means these goods are there. These sales what we have made from 1st Jan to 5th Jan, these goods were lying in the stock on 31st December. So we have to add back. The sales we have to add back. But remember, sales includes profit. Sales includes profit. So we have to deduct the profit from sales and we have to find out cost of goods sold, cost of sales. So instead of adding back the sales, we have to add back the cost of sales, cost of goods sold. So returns by customers, these are the sales return. 625. The rate of gross profit is 25% of cost. Now prepare a statement to show the valuation of stock at 31st December. So ultimately we have to find out what is the value of the closing stock on 31st December from the value of stock given in the problem on 5th January. तो हम क्या करेंगे, stock on 5th January, we take the stock on 5th January. To this stock we adjust all the items which are taken place between 1st Jan to 5th Jan, right? Now see carefully. Calculation of the value of stock as at 31st December, right? Stock on January 5th, 68,567 given in the problem. 5th January, stock is 68,567. Goods received means purchases. These are the purchases which are made after 31st December. So these purchases were not there on 31st December. 31st December को ये goods नहीं थे, 31st December के बाद खरीदा गया है. तो these goods will be deducted from the stock. From the stock on 5th January. The stock on 5th January is this one. From this we deduct the goods purchased. How much are the goods purchased? 4,600. So deduct 63,967. To this we add purchase returns. Purchase returns we add back. So goods returned between 1st Jan and 5th Jan, 200 rupees. So purchases we have deducted, purchase returns we have added. Now sales. Sales are given, but we should not take sales because sales includes profit. Deduct the profit, find out the cost of sales. That cost of sales we add up. So what are the sales that took place? The sales that took place from 1st January to 5th January. These goods were lying in the stock on 31st December. So that's why we have to add back. We have to add back the cost of goods sold which are made from 1st Jan to 5th Jan. The cost of goods sold between 1st Jan to 5th Jan. So how to calculate that one? Because in the problem cost of goods sold are not given. Sales are given. 10,500 rupees sales are given. And the rate of gross profit is 20% on cost. 20% on cost. Suppose if the cost is 100. Now I have explained you in working notes here. Sales between 1st Jan to 5th Jan is 10,500. And the rate of gross profit is given in the problem 25% on cost. We don't have the cost. So we suppose the cost. Let the cost be 100. The gross profit is 25. The cost plus gross profit is equal to sales. The cost 100 rupees, gross profit 25 rupees. The sales will be 125. So in other words, when sale 125, cost is 100. When sales are 10,500, how much would be the cost? So 10,500 divided by 125 into 100. 10,500 divided by 125 into 100. 8,400 is the cost of goods sold or cost of sales. That we have to add up. Add. Cost of sales 8,400. This is the explanation for 8,400. We have added. So it will become 52,567. When sales are added, sales return should be subtracted. Return from customers. Return from customers are the sales return. So it is given in the problem sales return are 625. Again, sales includes profit. So sales return also includes the profit. So we have to find out the sales return at their cost price. Problem में जो sales return दिया है 625, that is at the selling price. But we need the sales return at their cost price. So same logic will be applied. What logic we have applied in sales, the same logic we apply for sales return. Now see here, sales return between 1st Jan to 5th Jan 625 given in the problem. Cost price of sales return. cost price of sales return is 625 into 100 by 125, just like this. Just like the sales. Sales 10,500 into 100 by 125. Similarly, sales return is 625 into 100 by 125. 500 rupees is the sales return at cost price. At cost price. So at cost price, sales return is 500. So subtract sales return. So simply you subtract the purchases and add the purchase return. Minus purchases plus purchase returns. Plus sales minus sales return at the cost price. At the cost price. Sales नहीं लेंगे, cost of goods sold लेंगे. तो प्रॉब्लम में जो सेल्स दिया है उसको कन्वर्ट कर देंगे cost of goods sold like this. We have to convert the sales into cost of sales and add up. Subtract the sales return at the cost price. Ultimately, we'll get value of stock on 31st December. So we have returned back. We have returned back the stock from 5th January. We have calculated what would be the stock on 31st December. 72,067. This is the end of problem number 9. Now see the problem number 10. In pricing the gallons of petrol sold, service station A follows FIFO method, and while service station B follows LIFO method. There are two methods, there are different methods of pricing the material issues. Most commonly adopted method are FIFO and LIFO. FIFO, first in, first out. The material which are received first must be issued first. That is FIFO. LIFO, last in, first out. The material which is lastly received should be issued first. So here in this problem, service station A follows FIFO method and service station B follows LIFO method. Then on January 1st, on 1st January, both had the same quantity in stock, 6,000 gallons at rupees 2.60 per gallon. The opening stock of service station A and service station B are same. So both the stations will have 6,000 gallons at rupee 2.60 per gallon. Now during the month, each station received additional supply of 6,000 gallons at rupee 2.75 per gallon. So during the month of January, whole month of January, both the service stations have received 6,000 gallons at rupee 2.75 each. Sales of these two stations during the month were 8,000 gallons at rupee 2.90 per gallon. Both the stations opening stock same, both the station purchases are same, both the stations sales are same. Then determine for each service station the profit earned during the month and the value of petrol in stock at the close of the month. What is the value of the stock at the end of the month, 31st January? What is the value of the stock? Simply, we have to find out the value of closing stock. So two things we have to calculate. We have to calculate what is the profit made during the month, what is the value of stock on 31st January for both the service station. Service station A follows FIFO method and service station B follows LIFO method. It's very easy problem. Simply we have to apply the logic. Calculation of profit and value of stock on 31st January. This is the requirement. Service station A. This service station A follows FIFO method. First in, first out. Now I'll make a statement to calculate the profit. Remember, profit is the difference between sales and cost of goods sold. Sales minus cost of goods sold is equal to profit. This equation you have to remember. Sales. Both the service stations sold 6,000 gallons. No, sorry, 8,000 gallons. Both the service stations sold 8,000 gallons during the month at rupees 2.90 per gallon. So 8,000 into 2.90, 23,200 is the total sales for both the service stations. Now from this we deduct cost of goods sold. So cost of goods sold, opening stock. Both the service stations have opening stock on 1st January 6,000 gallons at rupee 2.60 each gallon. So 6,000 into 2.60, 15,600 is the opening stock. Both the service station have received additional supplies, means purchases. Received additional supplies means purchase. So both the service stations received purchases during the month. 6,000 gallons at rupees 2.75 each. So multiply 6,000 to 2.75, 16,500. So opening stock add purchases, दोनों को add कर लो, minus closing stock. Now you concentrate here. Closing stock. This service station A follows FIFO method. First in, first out. So how many gallons it has sold during the month? 8,000. How many gallons were there in the opening stock? 6,000. How many gallons purchased during the month? 6,000. So opening stock 6,000 gallons, purchases 6,000 gallons. So totally 12,000 gallons. Out of 12,000 gallons, 8,000 gallons are sold. So 12,000 minus 8,000. 4,000 gallons are remaining unsold. So closing stock on 31st January 4,000 gallons. At what price? Now see here. Service station A follows FIFO method. First in, first out. The opening stock, how much was there? 6,000 gallons. The whole 6,000 gallons was issued, sold. Purchases were 6,000. Out of 6,000, this 6,000 plus 2,000. Because totally how many gallons are sold? 8,000 gallons are sold. In this 8,000, the 6,000 opening stock was completely issued. So out of this 6,000, 2,000 are issued. Only 2,000 are issued. Remaining 4,000 are remaining closing stock. So first in, first out means opening stock was completely issued, and from the purchases only 2,000 gallons were issued. So 6,000 plus 2,000, this is 8,000. The remaining 4,000 gallons are remaining from the purchases. Purchases are at what price? 2.75. So this 4,000 into 2.75, 11,000 rupees is the value of closing stock. Now subtract. 32,100 minus 11,000, 21,100 is the cost of goods sold. I treat it as B. Now sales A, cost of goods sold B. So profit is A minus B, sales minus cost of goods sold. 23,200 minus 21,100, 2,100 is the profit of service station A, which follows FIFO method. Here for your understanding I have given service station A follows FIFO method. So closing stock of 4,000 gallons is remaining from purchases. Closing stock of 4,000 gallons are remaining from purchases, and at the rate of 2.75. So 4,000 into 2.75, 11,000 rupees is the value of the closing stock. That's what I have taken. Now, service station B, it follows LIFO method, last in, first out method. Only closing stock value will differ. All other values are same. So first of all, service station B, sales. 8,000 gallons are sold at rupee 2.90, both same. Both the service stations sold the gallons at the same price, 2.90, 23,200. Cost of goods sold, opening stock. Opening stock for both the stations same. For 6,000 gallons at 2.60, 15,600, same. Purchases, both the service stations purchases are same. 6,000 gallons into 2.75, 16,500, 16,500. The total is 32,100, 32,100. Now the value of closing stock will change because A follows FIFO, B follows LIFO. In B service station, it follows LIFO method, last in, first out. The last in. So your service station में opening stock was 6,000 gallons at 2.60. Purchases are 6,000 gallons at 2.75. So LIFO method if we follow, we will first of all issue the purchases. We issue wholly the purchases. So this 6,000 gone. And opening stock this 6,000, out of 6,000, 2,000 gallons are sold, remaining 4,000 gallons are remaining unsold. So this closing stock is remaining from opening stock. Closing stock of 4,000 gallons are remaining from the opening stock. The opening stock was at what rate? 2.60. So closing stock will be at the rate of 2.60. 4,000 into 2.60, 10,400. That is the value of the closing stock. Now subtract 32,100 minus 10,400, 21,700 is the cost of goods sold, COGS. Now profit is equal to sales minus cost of goods sold. Sales are 23,200, cost of goods sold 21,700, net profit is 1,500. This is the profit for service station B, and 2,100 is the profit for service station A, because the value of closing stock is different in both the service stations. Service station B follows LIFO method, so the closing stock of 4,000 gallons are remaining from opening stock. Last in first out, जो बाद में आया उसको पहले इश्यू कर दिया, बाद में क्या आया, परचेज आ गया, इसको इश्यू कर दिया, तो बचा हुआ जो स्टॉक है, कहीं में कहाँ है बचा हुआ स्टॉक, ओपनिंग स्टॉक. That is the difference. So this is the end of 10th problem. So viewers and my students, I have completed all the short problems on material. So if you want the complete grasp, watch the video till the end. Don't skip in the between, in the middle. So I expect that my viewers are seriously watching the video in order to get a good command, not only to pass the examination, but for your throughout life. We want a complete command on our subjects. From that point of view, I am explaining each and every point. So if you are satisfied with my lecture, give a like to the videos. Give your precious comments. How do you feel after watching the video? And share the video among your group, among your friends, so that more students will get benefit from these knowledgeable videos. I have uploaded many videos in my playlist. So you go to the playlist and select your subject, concerned subject, watch the video till the end, so that nothing should be left. So if you have not subscribed yet, please subscribe my channel. So I'll start the main problems of this material in the next video.